Do you think inflation is bad? Well, stagflation is worse. What we have is the recent back-to-back increase in inflation reports for the past 6 months and at a 9.1% 40 years high, coupled with a constant decline in annual economic growth. 80% of economists who took part in a Bank of America Global Fund survey named stagflation as the most significant long-term risk to the present economy. Stagflation is by far, in a way, the most accurate description of what the economic backdrop will be in the next 12 months. Unless you're well-grounded in finance or probably an economist, stagflation isn't as popular a term as inflation, recession, depression, and other economic terms. As you can guess, it's a word coined by combining stagnant and inflation. So in 1958, New Zealand economist William A. Philip proposed a theory that helps us better understand inflation and its relationship with unemployment. The theory states that there is an inverse relationship between the unemployment rate and inflation. According to the theory, high unemployment will slow down economic activity, thereby slowing down inflation, and low unemployment, on the other hand, will cause an increase in wages, making prices of consumer goods and commodities rise. This theory has proved beneficial to central bankers and economists when creating monetary and fiscal policies. So 12 years later, in 1970, something strange happened that shocked central banks around the world. There was a record of high inflation and high unemployment simultaneously. This phenomena violates the Phillips curve and brings fear with it. Why is stagflation such a unique, tricky, and strange economic situation? What causes it, and what parallels can we draw between the current economic situation in 1970? Let's find out. War, natural disaster, pandemic, or geopolitical issues, these factors can lead to scarcity of essential commodities like crops, oil, and precious metals. Scarcity naturally drives the prices of commodities to skyrocket, leading to high inflation. We saw a similar situation in 1973 when members of OPEC sanctioned the United States due to its support of Israel during the Yom Kippur War. The price of oil quadrupled by 1974. Currently, the COVID-19 pandemic and Russia-Ukraine conflict had led to some supply shock. The economic events of the 1970s are somewhat related to the financial situation in 2022, but there's still a lack of signals to conclude that we are in a stagflation yet. But if care is not taken, we might find ourselves in one. Avoiding stagflation is challenging because financial authorities are faced with striking a balance between two opposing forces: inflation and unemployment. Here's the tricky part. When central banks increase interest rates to combat inflation, it typically results in increased borrowing costs. This will lower customer demand and raise the cost of doing business. Employers frequently react by reducing their workforces, which increases the unemployment rates. On the other hand, central bankers may aim to reduce unemployment by lowering interest rates, giving firms an incentive to make significant investments, hire more employees, and take market risks. But wages increase when business is higher. In that case, consumer prices grow as incomes do, leading to inflation. Regulators are, therefore, mainly in a tight corner regarding stagflation. According to David Wilcox, a senior economist at the Peterson Institute for International Economics and Bloomberg Economics, recessions are the only known cure for stagflation. However, more conservative economists argue that one approach to controlling prices is by deregulating the industries. But it may take months or years for those impacts to materialize. And thank you so much for watching another episode of On Finance. I'm Ray. Make sure you keep yourself up to date with all of our social media, and I'll see you on the next episode.